Lesson 14, Harmonic Vibrations and Beats. Before we get started, I'd like to point out there's a sign in the top left-hand corner of this slide. That is a sign that you will see throughout this lesson. Whenever you see that sign, there will be some important information on that page. You may want to memorize it, study it, understand it, and incorporate it into your trading methodology. You'll also see in the bottom center of this slide a number. That is the number of the slide that we are on. During this lesson, if you lose yourself, just match that number up with the number of the slide in your workbook, and you should be caught up with us. There are 16 lessons on trading the Forex to help you. These lessons focus in on technical analysis, but are very applicable anywhere you can pull up a financial chart. One of the most profound statements, as you've heard me say over and over again, I have ever heard is this one: successful traders will do what unsuccessful traders can't and won't do. There is a big difference between successful traders and unsuccessful traders. There's a big difference between successful people and unsuccessful people. Whenever it's time for you to make a decision in your life, you may want to incorporate this statement and ask yourself, what would a successful person do in this situation? When it's time to make a trade, don't focus in on the greed. Ask yourself, what would a consistent, successful trader do in this situation? This statement can really participate in helping you out in your trading career. There is a 21-day 3% rule which states the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. The focus of this lesson is to teach you about harmonic beats and to have you apply that knowledge into your trading methodology. You do not want to lose this information. I will tell you, this information has had an incredible impact on many people's ability to trade in the market. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. You will learn how to read a trading chart and be introduced to the technical side of harmonic vibrations and beats. You will learn the natural laws of harmonic beats and see how they can help you improve your trading. You will learn that most financial markets move in a harmonic vibratory beat fashion and that you can figure it out for profit. You will learn to create a trading plan based on these laws and how to financially protect yourself at support and resistance on every trade. And before we get started, I would like to review reading a trading chart and placing orders. We are watching Japanese candlesticks which monitor the open, the high, low, and the close, and that there's bullish and bearish candles. Bullish candles represent white candles in this lesson, and bearish candles represent black candles. We are looking at a bid chart, and most traders look at a bid chart when it's time to trade. An ask chart looks identical to the bid chart, except that it is anywhere from 3 to 10 pips higher when it comes time to trading currencies. In all markets, traders buy on the ask and sell on the bid. That is very important information. Buyers buy from sellers. Sellers sell to buyers. So you buy on the ask and sell on the bid. When it comes time to entering the market and placing your orders, remember every buy needs 2 sells. When you buy and you place your protective stop loss order, remember that sell is on the bid, which means the candles will have to come up and go through it in order to stop you out. Now, your protective sell stop is on the bid, which means all this candle has to do is come down and hit that and you're stopped out. Conversely, when you sell on the bid, you enter. If there's a 3 to 10 pip spread, let's just say there's a 5 pip spread. If you enter the market and the current price is 107.30, you are filled at 107.35. Your protective stop loss order is on the ask, which means if this market rallies and the candle does not hit your ask price, you may be stopped out. Please understand this as to avoid frustration as you trade. Types of orders we'll be using are market orders. A market order is an order placed at the market on the bid or the ask. A limit order is an order placed to enter or exit the market at the exact placed price or better with no slippage. And a stop order is an order placed to enter or exit the market at an exact price that turns into a market order when touched. It may incur slippage. Now let's look at this chart. Any order placed above or below wherever the market is called an open, working, unfilled order. If that order is a buy order above the market, that is then a stop order. And if that order is a sell order anywhere up here above the market, that is then called a limit order. These are the rules of trading. Any order placed below the market that is a buy order is called a limit order. When you buy below the market, that's called a limit order. When you sell below the market, that's called a stop order. Ordering rules: every buy, if you're going to be a bull, you think the market's going to rally or go up, every buy should have two sells. One for potential loss. Quantify those losses before you trade. If you can't afford to trade, stay out. And a sell for profit. Now let's look at this chart. Lesson 6 teaches us that this market has entered into the buy zone. Market has entered into the buy zone. You enter on a buy, you're a bull. You need two sells, one for profit and one for potential loss. Ordering rules: when you're shorting the market, if you think the market's going to go down, and that's one of the great things about trading currencies, there's no special rules or regulations in shorting the market. All you need to do is, with the click of a mouse, short the market. You will then be a bear. Your position will be short. You want the market to go down. Every sell should have two buys. Let's look at this chart. You short the market, you need a buy stop for protective loss and a buy limit for profit. OCO means one cancels the other. Whether you're buying or selling, you need a limit order for profit and a stop order for loss. Whichever the market hits first, it will cancel the opposing order. That way you're not left out there with an open order that is unfilled. In canceling and replacing, please remember this: only cancel and place to the new last low after the market has made a new high if you are chasing the market in an uptrend. If you're chasing it in a downtrend, only cancel or replace to the last high after the market has made a new low. Now, lesson 3 as well as lesson 16 focus in on how to properly cancel or replace. These lessons are about technical analysis. Technical traders learn to read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. Now, why do you think charts can become predictable? Well, let me ask this question. Who trades in the market? Does the bank trade? Does a financial institution trade? Does a machine trade? Who trades? People do. People that work for the bank trade. People that work for the financial institution trade. People are the ones that trade. And people are creatures of habit. Charts monitor the buying and selling habits of the trader. Therefore, these charts can become predictable because people are predictable. Now, a chart is a chart is a chart, which means technical analysis is applicable to all markets anywhere you can pull up a financial chart. And once you've been educated on how the markets work, as far as technical analysis, you can start to control your financial future. I'd like to do a quick review on lesson 2, support and resistance. Remember, a high, 2 candles to the left, 2 candles to the right that are higher than the center high, and not all highs are resistance. A low is 2 candles to the left and 2 candles to the right that are higher than the center wick low or the body of the candle low, and not all lows are support. Let's look at a current trading chart. Whenever you see a current trading chart, you want to Scan the chart with your eyes and be able to visually see all your levels of resistance as well as all your levels of support. Remember, as you track your levels of resistance, every level, when you go from level 1 to level 2 to level 3, every level needs to be higher than the previous level of resistance. Just as well, every level of support needs to be lower than the previous level. Finding resistance is like walking up a set of stairs. Finding support is like walking down a set of stairs. Bulls want to take control of the market and establish new highs and take out the old levels of resistance. Bears want to take control of the market, take it down to new lows, and take out the old levels of support. All protective stop loss orders must be at the last low if you're buying and the last high if you're selling. Let's look at this chart. For whatever reason, if you buy, your protective stop loss order needs to be at the last low. Focus in on those losses. Quantify those losses. If you quantify your potential losses, the profits will take care of themselves. Every sell needs to have a protective stop loss order which will be at the last high. If you are bearish, place your protective stop loss order at the last high or the latest level of resistance. If the stop order is too far away from your entry point where you want to get in the market and does not meet your equity management requirement, pass on the trade and go find another one. Let's review trends and trend lines. Lesson 5. This is very important. Whenever the market is making higher highs and higher lows, it's called an uptrend. We draw our trend lines across the lows of support. See how we draw our trend lines across the lows of support? Now, there are three primary upward trend lines forming at any given time. One is an inner, outer, and long term. Lesson 5 teaches you how to buy and sell trend lines. Please review it. When the market is creating a lower low and a lower high, that is called a downtrend, and we draw our trend lines across the highs of the highs of support. The highs of resistance. Draw your trend lines in a downtrend across the highs of resistance. Once again, there's three primary downward trend line, a long-term outer, an outer, and an inner. Lesson 5 focuses in on how to trade those trend lines. Now let's review lesson 7, which is price swings, extensions, and Fibonacci numbers, because you need to understand that as we do this lesson. Leonardo Fibonacci discovered the universal numerical sequence, which means the sum of the previous two will equal the sum of the next. 2 plus 3 equal 5, 3 plus 5 equal 8, 5 plus 8 equal 13, all the way through infinity. 55 plus 89 equal 144, 89 plus 144 equal 233. Take 89, 144 equals 233, and now start to divide them. When you divide 89 by 144, you come up with 0.618. And when you divide 144 by 233, you come up with 618. And if I start dividing 233 by 144 and 144 by 89 and 89 by 233 and 233 by 89, I come up with a whole series of numbers. They are a 382, 50, 618, 786, 1.27, and 1.618. We equate these to percentages. 382 equals 38%, 50 50%, 618 62%, 786 79%, 1.27 127%, and 1.618 162%. You learn this in detail in lesson 7. Now, Fibonacci ratios are hidden potential levels of support. In an uptrend, as the market waves, it'll bounce at one of these Fibonacci numbers. And we learned that if it bounces at a 382, 50, or 618, it is going to rally. If it takes out the previous high, it will then or should continue to go to the 1.618 extension, just as you see here in this chart. See how the market rallied, came down, bounced right at that 382, and went straight up to the 1.618 extension. If the market bounces at a 786, it will only go to a 1.27 extension if it takes out the previous high. Look at how it bounced here at this 786, When it does that, the market is slowing down. Look at how much time it took to get to the 1.27 extension. We learned that swings move at different speeds. A 382 bounce, which is a very tradable swing, moves very rapidly. It offers fast profit. It offers being able to get in and get out of the market in a short period of time. You can see as the market's bounce at a 50, 618, or 786, it is slowing down. Now, downswings work exactly the same way and in the same numerical sequence. In a downswing, as the market retraces, these 382s, 50s, 618s, and 786s become hidden levels of resistance. The market should bounce at one of these locations if the downtrend is going to stay consistent. Now, in a downtrend, if it bounces at a 382, 50, 618, U-turns and takes out the previous low, it should go to the 1.618 extension. Let's look at here. Bounces at a 382, goes straight to the 1.618 extension and bounces. Now, in a downtrend, if it bounces at a 786 retracement number, U-turns, takes out the previous low, it should go to a 1.27 extension. Look at how it came down. Here's the original swing, retraced to a 786, bounced, and went to a 1.27 extension. If your data provider does not have Fibonacci numbers, please contact us immediately and we will get you hooked up with a company that has the Fibonacci ratio numbers as a part of its software. Downswings move at different speeds as well. They go from fast and aggressive 382 bounces to 786 bounces. Now, the reason you want to trade a 618 or 786 bounce, here's that important information, is just in case the market decides to reverse, break a trend line, crown. These are lessons you learn. Your losses will be small. And remember, if you listen to the market with your eyes and look where it's been, it will tell you where it's going to go. Look at how the market rallied, came down here, bounced to the 618. If that was your entry, you were probably planning on getting out of a 1.618. But instead, it came back to a 786. Now that it came back to a 786, you will now need to adjust your limit, look where it's been, and it'll tell you where it's going to go. There's the 1.27 extension. Now, lesson 14, harmonic vibrations and beats. This is probably one of my favorite lessons to teach because I never cease to be amazed at how the market that handles a $1.5 trillion daily volume can work not only in a Fibonacci sequence, but in a harmonic vibratory sequence. The knowledge of this harmonic vibration can be very, very helpful to your financial success. Because believe it or not, the market is governed by natural laws. You'll learn a lot about that in lesson 7 on price swings of Fibonacci numbers. Because the world is governed by natural laws, and none of us are above these natural laws. Now let's look at a piano and how it vibrates as it's played. If you look at keys, all keys vibrate. But for example, key C vibrates at 264 vibrations per second. Key E vibrates at 330 vibrations per second. Those vibrations become the sounds we hear. Key A vibrates at 440 vibrations per second. Believe it or not, when you start to take like key A and divide it by key C, I believe those are the two numbers. There's several keys that the ear likes to hear, and the body can incur goosebumps when listening to those keys because the mind and the ear and the body likes to see and hear things that are made in a Fibonacci numerical sequence. But if you take 264 divided by 440, I believe you come up with 0.618. Key C vibrates at exactly 0.618 of key A. Go into lesson 7, and I think we discussed that a little more in that lesson. But what things vibrate in our lives? Sounds. Whenever we listen to any kind of music, we're listening to vibrations. Earthquakes, they vibrate. The ocean and the water, it vibrates. How about radio waves? They vibrate. Let's look at water. Water usually is calm if there's no wind pushing it or moving it. But then all of a sudden, if a boat goes through the water, the boat disrupts the calmness of the wave, and it now starts to vibrate. Look at how it vibrates until it dissipates. Now, as the market moves, it vibrates. It vibrates up, vibrates down, and it vibrates sideways. Look at as it's rallying. Look at these waves. Don't these look like waves? Well, actually, they're vibrations. And in a Fibonacci sequence, they vibrate in a numerical Fibonacci fashion of 618, 1.618, 618, 1.618. Let's look at this chart. Vibrates up, retraces back to a 618, goes to a 1.618. New swing starts. Vibrates up, comes back to 618, goes to a 1.618. New swing starts. Vibrates up, comes back 618, goes to a 1.618. Now, in a downtrend, the market vibrates the same way as it dips. Look at how this market is moving. 618, 1.618, 382, 618, 618, 1.618 as it moves. See, look at this as it vibrates down. Goes down, comes back to a 382, goes to a 1.618. Just as you see it. Can you see it vibrate as it moves down? Now, in lesson 9 on consolidation and in lesson 15 on pennants, we learned that in sideways market, it waves in a numerical sequence. It also vibrates. See how this initial wave, it came back to the 786 of the initial wave, and then it came back to the 786 of that wave, and the 786 of that wave, and the 786 of that wave, and the 786 of that wave, until it dissipates. Look at this. Comes all the way back to a 618, then a 786, 786, 786, 786. And we learned in trading pennants, which is lesson 15, that you can literally short the market, sell, 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 buy, 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 as it is vibrating. As the market is vibrating, it lends itself to some great trading opportunities. Now, what causes the wave or vibration? Let's look at water. Fundamental announcements are like a boat that creates the initial wave. Remember the water being calm? I'm sure you've all have been on a boat. As you've been on the boat, you've kind of looked over the edge and you've watched the wave start. And then as you look back, you start to see the wave ripple and slowly dissipate. Well, a fundamental announcement creates the initial wave in the market. Look at how a fundamental announcement, which is a report that created the market to increase in value or decrease in value, created the initial wave, which then made the initial vibration in a harmonic, vibratory Fibonacci fashion. Now, as the market moves, it vibrates in a numerical harmonic beat. Now, in the Forex, the numerical harmonic beat is 60 pips. In other words, one beat equals 60 pips. And 1.5 beats equals 90 pips. 2 beats would equal 120 pips. 2.5 beats would equal 150 pips, and so on and so forth. All you have to do is multiply it by 60. 6 beats would be 6 times 60, which would come out to 360. 360 pip move would equal 6 beats. Now let's look at the market. Let's look at how it rallied right here. This is the Japanese yen 30-minute chart. Look at how it rallied from a low to a high. It went 90 pips up, which is a beat and a half. Then it fell from that high to that low. It literally fell 2 beats, 120 pips. Here's your pip value over here. Then it rallied up 60 pips, then came down 60 pips, then went up 60 pips, then dropped 90 pips, a beat and a half. Then it rallied from that low to that high, 120 pips, which equals 2 beats. Then it kind of went sideways in quarter and half beats, and then it fell 1 beat. This is amazing to me. You're looking at the Japanese yen, where literally billions of dollars are being traded at any given time as this market moves. Let's look at a euro. This is the euro 4-hour chart. Look at how the market rallied 180 pips up, then 120 pips down, then 120 pips up, then 120 pips down, then 120 pips up. Then it just dropped straight 480 pips down from that high to that low, or 8 beats. Take 480 divided by 60, you come up with 8 beats. Then it rallied 240 pips, 4 beats, fell. Then it rallied, it rallied 210 pips, 3.5 beats, fell 240 pips, 4 beats, rallied 180 pips, 3 beats, fell 240 pips, 4 beats, then U-turned and rallied 360 pips or 6 beats, then fell 2 beats. Look at how this, we're on a 4-hour chart. It all worked within a harmonic beat fashion. Now most markets have beats, believe it or not. Gold moves at $17 beat increments. Currencies in the futures market, if you want to trade futures, this is Forex, but futures, you know, I'll never forget going down at the CME years ago and literally standing inside the Swiss franc pit and watching those traders trade and watching all that commotion, the open outcry, the screaming and yelling, and to find out that those currencies in the futures market bounced in 27-point increments. It was amazing to me. The Dow, it moves on a 30-minute chart, it moves in 70-point beat moves. T-bonds move in 20-point beat moves. The S&P 500, it moves at 540-point moves. Soybeans, 18 cents moves. Those are beats. Wheat, 11 and 17 cent beats. Now here's a trading exercise. So what I'd like you to do is I'd like you to go find the beats in the following charts. Now to start tracking the current beats, all you need to do is start at a low or a high at the left of your chart and begin counting forward, up or down, moving from left to right. In other words, let's start right here. We pull up a chart. Here's the current market. I'm going to start at the left. I'm going to go 2 beats down. Here's my numbers. Then all I need to do is go from this low to this high, then from that high to this low, from that low to that high, from that high to that low. Do your major lows and highs. Now put your machine on pause and go find the beats. They should look like this. Look at how the market rallied up 90 pips. It rallied up 150 pips, 2.5 beats, then fell 90 pips, then rallied again, created that nice tweezer bottom. You learned that in lesson 11 on how to trade candlesticks. Rallied up, then it came back down, 2.5 beats, created a nice morning star. Look at this, rallies up exactly 240 pips, straight up. Goes 240 here, backs off a little bit, goes up another 240 pips. Then it kind of goes sideways, 100 pips down, 100 pips up, 120 pips down, 150 pips up, 120 pips down. Look at how it worked in numerical beats. Go find the beats on this chart. Put your machine on pause. Does it look like this? This is amazing. Look at how the market has moved within a numerical harmonic beat fashion. 2.5 beats up, 3.5 beats down, 1 beat up, 2 beats down, 2 beats up, 1 beat down, 2 beats up. Well, this is 100, 200. Yes, 108, 240 would be 4 beats up. Then you have 1 beat down, then 3 beats up. This is amazing. Let's look at this chart. Swiss franc. Go find the beats. Put your machine on pause. Does it look like this? Find the beats in this chart. Put your machine on pause. Is this what you found? Now here's a trading exercise. Now that I have shown you how to find the beats and you've done them, the best way to understand what you have learned is to write down what you think you know, then go back after what you've been taught, and let's see what you now know. Your perceptions are reality. In your workbook, I allowed you to look ahead and see what the beats were going to look like. Now go find the beats on these following charts. I'm not going to allow you to look ahead on these charts. It's important you walk through these exercises yourself. Find the beats on this 4-hour euro chart. Put the machine on pause. Find the beats on this British pound chart. Put your machine on pause. Find the beats on this Swiss franc 30-minute chart. Put your machine on pause. Find the beats on this Japanese yen 15-minute chart. Put your machine on pause. The reason I walk through several different charts is to show you that it doesn't matter what time frame, the market is still going to work in beats. Now, how does knowledge of the harmonic beats help the trader? Well, a completion of a beat can constitute the completion of a move. You will try to project the next bounce based on the completion of that beat. After you have taken a position, you will try to project the completion of the next beat for profit taking. And remember, the market bounces at the completion of beats. It bounces at completions of beats, it bounces at trend lines, it bounces at Fibonacci numbers. Those are all called convergences. The term convergence means a location where there is more than one hidden educated reason for the market to bounce, i.e. a trend line, a fib number, a completion of a beat, a morning star, a tweezer top or bottom. Now, please use logic when placing your limit orders to get out. Keep in mind Lesson 2, the financial game, Lesson 7, Fibonacci numbers, and Lesson 5, trends and trend lines. And when you start to combine the knowledge of all those lessons, support and resistance of beats, Fibonacci numbers and beats, trend and trend lines and beats, Gartley's and beats, when you combine all those lessons, you start to find locations and convergences where the market's going to bounce. Because if you can get in where the market's going to bounce, the market will move in your direction from the beginning. Now, let's trade a harmonic beat. Open up your software that's been created that allows you to literally pull the trigger with Monopoly money. You can trade beats live and show you and prove to yourself that you know what you're doing. And here's the rules to trading a harmonic beat. After you've turned on your charts, find and draw your trend lines, your inner, outer, and long-term trend line. This will help you determine if you are in an uptrend, downtrend, and it will give you a bias. It'll help you decide whether the trend line's been broken. Remember, your trend is your friend until it bends. Use your Fibonacci tools on your software and draw your Fibonacci lines and find the extensions for profit taking. Look at the latest price swing and start counting beats. Find the anticipated completion of a beat, a trend line, and a Fibonacci bounce, which is called a convergence. Look at the potential risk with your protective stop loss order at the last high or low, depending on the direction you're trading. If you can't afford the potential loss, then stay out. Pull out your trader's checklist and create a trading plan and trade that plan. Now let's face the facts. Every trader wants to find comfort in the number they're trading. And every trader wants the market to move in their direction from entry. Education on how the market works improves those percentages. Watch what happens when you combine your education on all these other lessons in harmonic beats. You turn on your computer, you spot an uptrend. So the first thing you do is you draw your trend lines. You find an outer trend line and you find an inner trend line. You see the latest swing. You see a latest upswing, retracement, and extension. If this trend line is to stay active, or if this uptrend is to stay active, it should vibrate again. Why? Because it just completed a 1.618 bounce, which means it's probably going to come back down. And as it comes back down, we want to buy after the market has retraced or retraced back to the 618 or 786 trend line and completion of a beat, because we draw our trend lines across the lows. Now look at how we drew our trend line here across the lows. We now spread our Fibonacci's from the latest upswing. There's the latest upswing. These then become our Fibonacci numbers: 382, 50, 618, 786. And what we do is we go from the last high and count back to the 618. Look at how when you count back from the last high to the 618, we come up with 2.5 beats or 150 pips to the 618. What happens if we count all the way down to the 786? Well, if we count back to the 786, look at how it comes to exactly 3 beats or 180 pips. But as we eat up time, the market is going to move. The trend line is slowly going to move up. And as this falls, it looks as though as time moves against price, this trend line will rise and hit the 618. So my logic tells me that it looks as though this market is going to dip and hit the 618 and trend line with time. Just as I pointed out in this slide, trading is all about price movement up and down against time. Now, our strategy is to limit in, meaning we're going to place a limit to buy right now below the market. When you buy below the market, it's a limit order. I'm going to buy the trend line 618 2.5 beat convergence, because that's where we should have a bounce. Convergence means a location where there is several educated reasons at one location why the market should bounce. If I get in right here, placing my stop at the last low, this market should move in my direction from the beginning. So I'm going to place my order to buy the 618 with a protective stop loss at the last low and a profit limit to get out before it hits the 1.618 extension. Now, why is knowledge of the harmonic beat so important? It helps in projecting the retracement bounce for getting in and the extension bounce for getting out. And that's important for our profit taking. Place your limit order to enter into the market at a convergence and before the completion of the beats, that's to get in. And place your limit order exit to get out before the completion of the beat. Now remember, trading is all about understanding price movement against time, and because of that, we have to buy into a trader's mantra. Don't jump the gun. Here should be your mantra. I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management. I will never trade without a protective stop loss. I will not chase the market. I will be patient. And the market will meet the criteria of my trade, or I will not trade. Pull out your paper trading form. Keep a track record of everything that you do. And let's be patient and wait. Now, these are 2-hour candles, which means we've waited 2, 3, 4, 5, 6 candles. We've waited 12 hours. That's okay. We're traders. That's what we do. We sit and we wait, just like a hunter sits and waits until the setup takes place. Now the market dips exactly 2.5 beats, just like we projected, hits the 618 and trend line and bounces. Look at how it moves in our direction right straight from the beginning. Look at, from where we got in, it bounced literally 2 beats up, 120 pips. Good, nice, hard bounce. And with time, we had to be patient, but look how from our entry, the market rallied literally 100, 200, almost 300 pips from our entry. See how it paid off? And here's where we entered. Now, let's look at it in a beat fashion as well as a Fibonacci fashion. The market rallied up 4 beats, retraced back to our entry 2.5 beats, rallied up 1.5 beats, decided to pull that old Gartley that we learned in lesson 13, does a Gartley, comes back to the 786, and then slowly makes its way up 4 beats up, comes back down 2 beats, and eventually makes it to a 1.27 extension. Look at how it moved within a beat as well as Fibonacci numerical sequence. Now, your software will keep your P&L statement, but fill out your paperwork, fill out your P&L statement so you keep track and can go back and look at what you've done. Now let's look at these charts. Look how the market retraced back to a fib number and the completion of a beat, then went to the extension in beats. Look at this. This is amazing. This is probably this slide here and the next slide. If you walk away not believing that these markets move in a natural, harmonic, vibratory fashion, I mean, we're talking the Forex that produces $1.5 trillion in daily volume a day. Are you telling me that there's a conspiracy out there that moves all this? I mean, all these traders are on the phone worldwide saying, okay, hey, let's move 4 beats up. Okay, it's time to stop. It's time to go back 2 beats. Now we're at a Fibonacci 618 number. It's time to bounce. It doesn't work that way. There is a natural, harmonic, vibratory law that governs our lives, and it also governs the market. This is amazing. 4 beats up, 2 beats down to a 618, rallies up, hits the 1.27 extension first, which happens many times. Talk about that in lesson 7. Comes back 1.5 beats, bounces again, goes up 3 beats, finally to the 1.618 extension, and bounces back down. Look at this. 4 beats up, 3 beats down, 5 beats up to the 1.618 extension. Look at this. Upswing down to the 618. This is the euro yen. What do we have? A bunch of Japanese people talking with European people saying, okay, hey, look, because we're trading the euro yen, let's all just go up 4 beats, and then we got to stop here, and then we've got to reverse 3 beats. Doesn't work that way. Doesn't work that way. Downswings vibrate exactly the same way. They vibrate in a harmonic fashion. Look at this one. 6.5 beats down. This is the Swiss franc 2-hour chart. Then came up 3 beats, then down 3 beats, then up 3 beats, then down 7 beats, all the way to the 1.618 extension, and then bounced. Here's the swing and its extension. This is amazing. Now, let's short the market using harmonic beats. Once again, let's boot up our software. The rules are the same in trading a downtrend as they are an uptrend. We're going to find our trend lines. We're going to see if we're in an uptrend or a downtrend. We're going to use our Fibonacci tools. We're going to count the beats starting at the left of the page, moving to the right. We're going to look at our potential risk. If we can't afford it, we're going to stay out. We're going to pull out our trader's checklist and create a trading plan. Now pull out your paper trading form and fill it out, and let's find a convergence of harmonic beats in the direction of the trend. Circle your convergences, your Fibonacci numbers, your dates, your downtrend. Go find all your support and resistance. If you're going to choose to cancel or replace, use this section of it. How to use this sheet is at the back of your book. Now start drawing your trend lines. You turn on your chart, and this is what you see. Put your machine on pause before you move forward. You draw your trend lines. See if you spot the reversal that exists here. This is what your trend line should look like. You have an outer trend line here. You have an inner trend line going up here. You can see the inner trend line's been broken, which means we are now making lower lows and lower highs. We're in a downtrend, which means we now need to draw a new down outer trend line. Now, trading a downtrend, here's the rules. Sell after the market has surged to make a lower high equal with the trend line at the 618 or 786 Fibonacci number and the completion of a beat or several beats of the last down price swing with a protective stop loss order at the last high. In other words, as the market is going to surge here again, we're going to sell as it hits this trend line with a protective stop loss order at this last high. In other words, if we were to have sold this trend line, our stop would have been here. If we'd have shorted that trend line, our stop would have been there. Sell those trend lines. And remember, here's an important information. When the market breaks inner trend lines, it usually goes to an outer trend line. Now draw your Fibonacci numbers of the latest price swing. See the downtrend, see the wave 1, wave 2. How many beats up at the completion of this wave is it? It looks like a half a beat to the 618. So our strategy is going to be to short the 618 after it's moved to half a beat. Now, we sell the 618, there it goes, it surges to the 618. It has now completed a half a beat. This trade lends itself to a tight stop because it looks as though our stop loss order is only about 30 pips away, which is going to be about $300. And we are anticipating the market to move all the way down. Because it's bouncing at a 618, it should go to a 1.618. If it drops to a 1.618 extension, that will be the completion of 1.5 beats. Down from here to here will be 1.5 beats or 90 pips. So this lends itself to a great trade. We have a convergence, a 618 trend line, completion of a half a beat convergence. We have another convergence down here, a 1.618 extension, completion of a beat and a half, and outer trend line. Now look at how the market not only came down to the outer trend line but blew through it. Obviously a fundamental announcement. When you learn on how to trade on trading days and trending days, this would have made an excellent trending day trade. But look at how the market literally fell 2 beats down and literally went to the 1.27, 1.618, 2.618 extension and has stalled. It's amazing. Your software will keep track of your P&L statement, but still figure it out for your records. Now this is one of the most amazing things I have ever seen in my life, and that is on September 11th, terrorists attacked the United States. It became a part of everybody's life. It's one of our saddest days in history. Even with all the confusion and chaos in the world, the financial markets still moved in a harmonic, vibratory motion sequence. The currency markets never closed. The stock markets did. The stock market closed for a week, and when it reopened, it responded in a Fibonacci numerical sequence. But look at this, September 11th. The Swiss franc was slowly in an uptrend. All of a sudden, terrorists attack America. The market dropped 9 beats straight down on the Swiss franc, which means it's being traded against the dollar. As the Swiss franc falls, it is strengthening, the US dollar is weakening. But look at how the market, previous to September 11th, rallied 3 beats up, came back down a beat and a half, rallied up a beat and a half, formed an evening star, then fell 9 beats. After it fell, it rallied back up 4 beats. Then it fell 3.5 beats down. Then it rallied up 5 beats. During this 24-hour period, I don't recall watching on the news anywhere any newscaster saying, okay, everybody trading currencies, we can only move 9 beats down and go back up 4 beats, and then once we hit 4 beats, we got to reverse and go back down 3 beats, and then once we go down 3 beats, we got to reverse and go back up 5 beats. I don't remember anybody saying anything other than about the attack and the potential victims and survivors. That was the focus of the world. The focus of the world was the devastation the terrorists did on America. But yet, the markets worked in a natural harmonic vibratory sequence. Look at the Japanese yen. This is a 30-minute chart. Market had gone up on September 10th, 4 beats up. Then all of a sudden the attack, it fell 6 beats down, 360 pips. Then it rallied 2.5 beats, 150 pips. Then it fell 2 beats down, 120 pips. Then it rallied 1.5 beats up, 90 pips up. Then it came back down 60 pips. Then it went sideways. Here's your prices over here. Here's your time. This is amazing. Look at the British pound. British pound fell 2.5 beats prior to the attack. Then on the morning of the attack, September 11th, there it is. Market rallied 4 beats up. Then came down exactly 1.5 beats. Then rallied 1.5 beats. Then fell 2.5 beats. Then rallied up 1.5 beats. Then calmed down. I'm pointing out the major world currencies. You're talking about $1.5 trillion in volume trading hands here, and it moved in a beat fashion. September 10th, the euro. Look at how it fell. 2.5 beats. Then the attack. 4 beats up. Market rallied 4 beats. Then it fell exactly 120 pips. Here's your pips. There's 100 pips, 120 pips. It fell. Then it rallied 90 pips. 1.5 beats up. Then it fell 2 beats down. Then it rallied a beat and a half. This is amazing. What's even more amazing is to go back and find the beats in the Dow, find the beats in the S&P, find the beats in your stocks. They all move within a natural, harmonic, vibratory fashion. The best way to understand what you've learned is to write down what you thought you knew versus now what you now know. Remember the exercise where I said your perception is your reality? If what I've shown you doesn't make you a believer that the market works in beats, and understanding how the beats work places you in a higher percentage chance of making money, then perhaps trading is not for you. But the fact of the matter is this: the markets move in a vibratory fashion. Pull out your sheet of paper, and this is what you should have. This is the Euro 4-hour chart. It doesn't matter at what period or point in time. They have been moving in a harmonic, vibratory beat fashion for years. Success comes to traders who figure this out. Here's the British pound 2 hours. It should look like this. Why does this become helpful? Because if your decision was to enter the market right here, wouldn't it be nice to know that, hey, I'm thinking about buying the British pound on July 17th at about 1.40 to the dollar, and look at how the market moved in your direction right away? Boy, that provides comfort in the number that you choose. Look at the Swiss franc. Is this what you came up with? One beat up, half a beat down, 2 beats up. Market kind of went sideways in quarter beats, half beats, then fell. Look at the Japanese yen 15-minute charts. I used a variety of charts just to prove to you that it doesn't matter the chart. It moves in a variety of charts. 2 beats down, half beat movements, sideways. Even when the market goes sideways, it moves in half beats. 1 beat down, 1 beat up, 1 beat down, a half beat up, 1 beat down, 1 beat up, half a beat down, 1 beat up, half a beat down, 1 beat up. Now we're starting to climb. Once again, here's your rules to trading harmonic beats. Let's all agree. If you're going to be successful at trading, you've got to have an edge. You've got to educate yourself so that you know where to get in and understand the why behind it. You've got to educate yourself and know where to get out and understand the why behind it. I taught a trader one time. He said to me, you know, Jared, I know exactly where to get in. I just don't know where to get out. Get out before it hits those extensions and bounces again. Know where the natural laws are that govern the market. We got to understand that. You need to understand that the market moves in harmonic beats, and that when we enter a 618 or 786 trendline convergence, it places us in a greater position to grab profit. And let's all agree, you got to create a trading plan and trade that plan. Now, did this lesson teach you that the markets are governed by natural laws? It is. Did this lesson teach you how to read a price swing and its extension? Did this market teach you that the market moves in harmonic beats, and entering the market at a 618 or 786 trend line, completion of a beat can create greater potential for profitability? Did this lesson teach you that you must create a trading plan and trade that plan? Did this lesson teach you how to create a Fibonacci number, trend line, and harmonic beat trading plan and trade that plan? Did this lesson teach you where to place your protective stop loss order, and that if you can't afford the loss on that potential trade, then stay out? If the lesson did not teach you that, then go back and replay this lesson over and over again. Why? Because if you don't, you may land in the category of the 90% that fell. Because the reality of trading is this: 90% of most novice traders fail, and only 10% succeed. Why is that? I believe it's because successful people, successful traders will do what unsuccessful traders won't do. Successful people are not lazy. Successful people focus in on their profession, on their niche, on what they're going after. They take the time to educate themselves and study. Do what a successful trader will do. There's 2 ways to pay for your education along the way. As the saying goes, when a man or when a person with money, and many times we think just because we have money, we're just brilliant people. When a person with money goes up against a person with experience, after everything's said and done, the person with the money ends up with the experience, and the person with the experience ends up with the money. Now, there's 2 ways to pay for your education. If you jump in the market, you have to be told where to get in and have to be told where to get out. Then chances are you're going to always be looking for somebody to tell you where to get in and where to get out. Because if you were told where to get in and you got lucky, then it'll only be a matter of time that you'll become unlucky in the market. And when you become unlucky in the market, you will not have the proper education or the know-how or skill to figure out how to go earn your money back. We here at Market Traders and ForexTips.com believe in mentorship. We believe the best way to learn how the market works is to hold on and grab on to a mentor, a trading coach. Best definition I've ever heard of a coach is this: is an individual who can take an experienced player to a higher level of accomplishment. That's what our goal is here at Market Traders. We want to take experienced people, experienced traders to higher levels of achievement when it comes time to trade in the market. Because educating yourself on how the market works is like buying a map to a gold mine. Because there is gold in the market and you need to learn how to extract it. You can learn where to get in and where to get out and the whys behind it in the market. Because let's face the facts, every trader wants the market to move in their direction from entry. I met a guy down in Fort Lauderdale. He said to me, he was an ear, eyes, nose, throat doctor, retired. Said to me, he bought $1.2 million worth of stock in AOL right at the tip, right at the top before it fell. And he ended up cashing out for only $500,000. He took a $700,000 hit. Now you tell me, that became his worst and every other trader's nightmare. There's no greater fool than an ignorant bull in a bullish market. Every trader wants the market to move in their direction from entry. Education on how the market works can improve those percentages dramatically. There's 16 lessons in this series that can teach you how the Forex works as well as how to understand technical analysis. They come with trading exercises that allow you and software to practice before you trade. Doctors operate on cadavers first. You need to buy into a trader's mantra, which is, I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management so I can survive. I will never trade without a protective stop loss. I will not chase the market unless I do it in a very educated fashion of canceling and replacing. I will be patient and wait till the market sets up. And if the market doesn't meet the criteria of my trade, I will pass. Why? Because the market goes 24 hours a day. You can find a trade just about every 15 minutes. It's like being at a bus stop. And remember, because this does take some spatial intelligence, if the chart is not clear and doesn't visually make sense, and if you have a problem with the chart making sense, go into ForexTips.com. We have a 24-hour chat room where you can talk to an expert trader, a trader who understands technical analysis. Ask him, say, this is what I see, what do you see? We'll pull up the chart. We'll analyze it with you so that you can learn along the way. But remember, if the chart is not clear and doesn't visually make sense, when in doubt, stay out. Because of this 21-day 3% rule, the human mind forgets 80% within 3 days. Use it or lose it. Our focus is to get you at 85 to 95% recall when you trade with real money. And on behalf of your family, on behalf of your heirs, on behalf of those people who will be the benefactors of your hard-earned money that you put into the market to increase your wealth and fortune, everyone here at Market Traders Institute and ForexTips.com, along with all those people, want to thank you for investing in yourself and purchasing this lesson.